Welcome to All About Investments by Arohan, attempting to demystify investment for retail investors. In this module, we will be covering the concepts of modern portfolio theory. In the previous sections, you have understood each asset class, their risks, their returns, your investment objectives. Now, finally, we will assimilate all the information in this section to create a portfolio for you. And on the basis of the modern portfolio theories supported by high-tech technologies. So based on our research, the way we have seen real estate being overweight in each uh, investor portfolio, we have to first balance that, bring it down to weightage to like more like 1/3. You can have one house to live plus one more, right? But rest of it has to be moved to financial assets like stocks and bonds because they have better risk adjusted return and the future outlook is better and they have higher liquidity. It is very difficult to generate liquidity from real estate. Even rentals is just about 2% of their market value, right? And that's the way you minimize your risk through diversification in different asset classes. So you have a balanced portfolio of physical asset 1/3, stocks 1/3, bonds 1/3. Now, if you look at the way you manage your financial portfolio, right, which is a portfolio of stocks and bonds, which is liquid and can be rebalanced properly, right? Then first principle you follow is the quality. Restrict yourself to quality stocks and bonds. We use about 200 quality stocks across themes and about 50 quality bonds across duration. And while you start with a equal kind of portfolio between stocks and bonds, you rebalance the asset allocation for optimizing returns. This is fundamentally on the belief and empirical facts that each asset class have long periods of flat return followed by periods of stellar performance. And key to getting high returns is to catch growth phase of each asset class. Of course, that's an expert uh, activity and cannot be tried by retail investors. But rebalancing can be simplified. Retail investors can do passive rebalancing. They can start with a 50-50 balance of stocks and bonds. Equity, they can use low-cost mutual funds or ETFs. If they want, they can blend about 20% value stocks through mutual funds. Debt, they again have to use low-cost mutual funds, right? They can use higher duration, 15-year duration kind of instruments for they can use mutual funds which use 15-year kind of duration instruments, right? And when the interest rate come down over next 2 to 3 years, they can move towards reduce the duration in their mutual fund. Right? Once they have found appropriate tool and build their 50-50 portfolio, then every year or quarter they can rebalance it and make it 50-50. One of these asset classes would have become higher than 50%, the one which has done well. So you need to sell little bit of that and buy little bit of the asset class which has not done well so that it becomes 50-50. If you are using SIP, adding investment, then whenever you add SIP, you try to maintain this balance. And by doing this, you would be generating in long term a fairly expert quality return. Expert can better it with dynamic rebalancing. it's an expert game. Sometimes they go wrong and then they can underperform passive rebalancing. But if they do it well, and if you go to real good dynamic rebalancing experts, then they are able to uh, time the market in a better way, right? Dynamic changes, they are made to debt equity ratio. We do it on weekly basis, right? We do dynamic changes to sector allocation in equity. We do dynamic changes to duration allocation in debt. We also use fundamental analysis essentially to find out what to buy and sell, and we use technical analysis to time it, when to buy and sell that fundamentally decided trade. Right? But dynamic rebalancing, you have to go to experts. We are one such player in the market who do this particular activity, and our in the next slide gives our core value. Asset allocation with rebalancing, right, is our core value. Not only it reduces risk, right, but it also optimizes return, right, and that's the fundamental theory of modern portfolio theories, right. Technology has been a great help. We do the same, right. If you take an asset allocation example, which we gave in August of 2015, right, when he determined the stock and bond market outlook first, we realized that the stock markets are going to be in the range of 7,800 to 9,000 for next 9 months, because investment cycle, if it revives, it will really move up. But if it hasn't revived and it is taking more time, right? Bond market also, we kind of looked at, we were very certain of interest rate going down by about 200 basis points over next 2 to 3 years, and that will guarantee you a 13% post-tax returns, right? On that perspective, we are more or less equal in stocks and bonds. From risk-reward perspective, at 9,000 Nifty levels, we should go little underweight equity and little overweight bonds. At 7,800, we go little overweight equity, right? So that's just an illustration, right? So finally, if you are a retail investor, if you have to create equity portfolio without getting into the complication, you can use low-cost mutual funds or exchange-traded funds. Right? You can also have a large cap 80% with 20% value blended. Right? The experts do it in a more complex manner. Right? If you need help, there are experts like us who can help you build a portfolio of individual stocks. In that case, you don't have to go through the cost of mutual fund expenses, which could be a very high portion of their return, in most cases about 20% of their return over a long period of time. Right? In that case, we can help you. Similarly, if you have to build a bond portfolio, you can build it through mutual funds. And of course, in a falling interest cycle, you have to have long duration instrument in that mutual fund. When the interest rate falls, then you have to shift towards shorter duration bonds and associated mutual funds. But recent changes in tax rules has ensured that buying direct bonds is a good option. Buying direct bonds again is an expert game, as you can see on the slide, right? And don't attempt directly. But if you need any help, you can take benefit of expert advisors from our organizations. Thank you.